I'd like to take this opportunity and discuss question number 2 on the sample midterm exam. So this company called Monroe Corporation needs a new machine. It's going to cost $100,000, and it's going to depreciate this machine on a straight line basis over 5 years with no resale value. Okay, the tax rate is 28. After tax cost of capital is 11%. Machine will have an EBIT of $18,000 per year, every year for the first 5 years. And then there's going to be an uncertain amount for the next 5 years, which is actually through year 6 to 10. So you need to find the minimum amount of this uncertain EBIT, which makes this purchase of the machine acceptable. All right, so let's look at the setup. So you're talking about a machine. This is a capital budgeting problem. And we're talking about 10 years. So let me build a 10 period timeline. And we're looking at this machine, and we have the machine cost, and then we have the depreciation methods, and so on and so forth. Okay. So machine cost, that's $100,000. Okay, I put it down as negative because you're paying for it. And then you have the depreciation. It's a straight line depreciation. So let me actually get the annual depreciation, which is nothing but the machine cost. And I'm using absolute value so that I can just get, $100,000 positive. And let me lock down the cell reference. And this is actually depreciated over 5 years with no resale value. So, we're going to depreciate this over 5 years. All right. And you may ask me, what about year 6 to 10? Well, in year 6 to 10, the machine is going to still generate EBIT, but we actually fully depreciate this machine by end of year 5. So there's no, depreciation from year 6 to year 10. Okay, so that's apparently a little unusual. All right, and then we're going to have the tax rate, 28%. So let me just put down tax rate as 28%. And we have the after-tax cost of capital. We just call this, after-tax cost of capital. And this is apparently the discount rate we're going to use. That's 11%. Okay. And then we need to, EBIT. So the EBIT for the first 5 years, that's $18,000. It's actually $18,000 for the first 5 years, but then it's going to be an unknown amount in the following 5 years. So I'm going to guess the unknown EBIT. So I'm talking about Excel solver. So how about 12,000? Okay, this is a wild guess. So I'm going to use the $12,000 here, and that's going to be the EBIT from year 6 to year 10. And in this case, we know that the minimum amount of, this EBIT is the EBIT that makes the NPV equal to 0. Okay, so we're going to calculate the NPV by using the guess, all right, or use the guessed EBIT. All right, so this is actually a capital budgeting problem with tax. So we need to consider after tax cash flow per period. That is our methodology. Okay, you give me tax, I'm going to consider everything on the after tax basis. So here we're looking at, remember, there are 2 ways for you to get, after tax cash flows. One is you take your EBIT, you take out the depreciation, and you pay tax. All right. And then because you take out depreciation, now you put back depreciation. Okay. So that's going to be your after tax cash flow in the first year. All right. That's 18,560. And I can copy this across. And you see that, in the last 5 years, there's no tax benefit of depreciation because there's no depreciation. So your after-tax cash flow is going to be different. Okay, and of course your EBIT is actually unknown, so we guessed 12,000. So that also creates the difference between the after-tax cash flow in in the last 5 years as compared to in the first 5 years. All right. So that's one approach. You can also do the other approach for after-tax cash flow, which is you take the EBIT and you pay tax. All right, and then you pick up the tax benefit of depreciation, which is the tax rate times the annual depreciation. Okay, so if you do that, you still get 18,560, but it's going to be much lower after-tax cash flow in the last 5 years. Okay, so let me just say alternatively. This is the second approach for calculating after-tax cash flow. So now I can actually calculate the NPV. We know the Excel NPV function is messed up, but we can still use it if you know how it is messed up. So we're going to look at the present value of all the future cash flows, and we manually put back initial investment. All right, so that's going to be the NPV for this particular project, and I need to format this as a dollar. This is telling me if the unknown EBIT is 12,000, then this is actually a bad project because the NPV is actually negative. Okay, so now I'm going to correct my guess. So this is my 3-step procedure. You guess, you calculate, you correct. Okay, so we're going to invoke solver. We're going to set B14 as the objective. We're going to set that equal to 0 by changing the guess in, where's my guess? Well, that's in D9. All right, so if I do solver, I should be able to find the minimum level of the EBIT. So let me go to solver here. This is my objective. Set that equal to 0 by changing my variable cell, which is the guess I took. There's no other constraint, so let's click solve. Solver says I found a solution here. Your a minimum amount of EBIT is $19,886. Okay, solver finds the minimum EBIT of $19,886.10. Okay, so I hope this is useful.